So now we're on to Chapter 8, and we're looking at home insurance, home insurance, and automobile insurance. If you haven't figured it out, what we've done is we're taking this apart in terms of your expenses. Think about it in terms of your fixed expenses. When we're looking at consumer loans in terms of purchasing cars, appliances, so on and so forth, installment loans, if you will, and mortgages as well, of course. These are the fixed notes, meaning that you know what the expenses that you're going to be encountering on a monthly basis, if you will, typically. Onward. So now we're moving on to homeowners insurance and automobile insurance, and these are also fixed expenses, if you will, going forward. Objective 1, identify types of risks and risk management methods and develop a risk management plan. This has, of course, to do with insurance concerns. Assess insurance coverages and policy types available to homeowners and renters. Analyze the factors that influence the amount of coverage and cost of homeowners insurance. Identify the important types of automobile insurance coverage. Evaluate factors that affect the cost of automobile insurance. Typically, by the way, insurance, when we're talking about homeowners insurance and casualty insurance, automobile insurance, in states like in Michigan, they're controlled by the state. These are state agencies that dictate terms, so to speak, so far as insurance coverages and so on and so forth are concerned. So insurance is different in Michigan than it would be in other states, again, for example. So you purchase a policy, whether you're talking about automobile insurance or homeowners insurance or home insurance, as they refer to it here. You purchase a policy, and that's known as coverage insurance. The firm assumes a risk for a fee, if you will, and the fee are the premiums that are paid on a monthly basis. That the U.S. Policyholder pays for that the eventuality, the possibility of experiencing some loss associated that the insurance covers. That's really what it comes down to. So you pay premiums, and they collect the premiums, and when there is a problem, they would be paying out, presumably, to make you whole once again, assuming that you have coverage for your coverage that you have covers the incident, if you will, the occurrence. Anyway, types of risks would include chance or loss of injury, chance of loss or injury, uncertainty or lack of predictability. Again, this is the insurance principle, if you will. You're insuring against the unknown, about stuff that you don't know, something that's over the horizon, something that you don't realize. The expression is, you don't know what you don't know. So you try to insure against some of that, whatever portion that you can. Insurance, as opposed to we won't get into that, but peril is the next item, and anything that may cause a loss, fire, windstorm, robbery, accidents, floods, etc. You have to have insurance that addresses or speaks directly to those things that occur. Otherwise, you might have insurance, but you may not have flood insurance, and you get flooded out, and you're not covered. Therefore, you need to have insurance to cover whatever the prospective possible loss might be. Hazard, anything that increases the likelihood of a loss. So if there's a flood hazard, if there's driving drunk, defective house wiring, so on and so forth, some things that may or may not be covered. So if you get an accident and you're drunk driving, chances are your insurance would not cover that. Anyway, you get the idea. You're insuring against the unknown, as opposed to an expression called moral hazard, and that is that you are disobeying the speed limit, and you're going too fast, and you get into an accident. insurance may or may not cover it, depending upon, again, the circumstances. Things that you could have prevented or stopped from happening, prevented happening in the first place. Anyway, common types of risk: personal risks, property risks, liability risks, losses caused by negligence resulting in injury or property damage. And you can insure against all of these things, but the more risky is your behavior, the more risk that's employed, the higher the cost of that insurance. You can pretty much insure against anything. Pure risk is the insurable risk, accidental, unintentional nature, financial loss of the risk that can be predicted. The nature and the financial loss associated with the risk can be predicted. Speculative risk is uninsurable, chance of loss or gain, starting a small business or gambling. In essence, these are things that you can't insure against because you can't. There's nothing that you can do to offset it, if you will. Or there are things that you can do to offset it. Is more specific. To prevent gambling losses, you don't gamble. To prevent business losses, you don't start the business. You don't have a business that is likely to fail. Anyway, a lot of things that kind of go along with the insurable. Pure risk is personal risk is equal to the loss of income or life. Property risk is loss of property. Liability risk, losses caused by negligence. Negligence is equal to the failure to take ordinary care to prevent accidents that we've talked about before. Driving under a mile an hour in a 50-mile-per-hour zone and getting into an accident, causing injury to yourself and or others, etc. That's negligence, something that you could have avoided. Risk avoidance, taking precautions to avoid the risk, so long as you're doing the right things, if you will. Risk reduction, taking actions to reduce, again, the risk, avoiding the risk, reducing the risk. Risk assumption, that's the insurance company. The insurance company assumes risks. Risk shifting, insurance buyer. If you're buying the risk, you're shifting the risk from yourself to the insurance company who is assuming the risk. These are all insurance terms that would be going along with this. So different things to avoid risk, different things to, so far as risk assumption is concerned. Risk reduction, wearing a seatbelt, installing alarm systems, etc. Risk shifting, buy insurance, and risk assumption, self-insurance. A lot of companies, rather than buying insurance, they are self-insured, meaning that they take on the role of the insurer. They take on the risk. They assume the risk. Risk and risk management strategies. There are different types of insurance that are out there. For disability, again, physical loss, if we're talking about loss of income, services, increased expenses. Personal resources employed would be savings, investment, family observing, safety precautions. Private sector disability insurance. So there's private sector and there's also public sector disability insurance, meaning where there's insurance set up to prevent against that loss, becoming disabled. Illness, catastrophic illness, health insurance, and so on and so forth in the private sector side, health insurance, and the public sector side, military health care, Medicare, and Medicaid. Medicare is for the elderly, 65 and older, and Medicaid is for indigents, people who can't, with low incomes, etc., that receive insurance in that manner. Insurance in case of death, life insurance, of course, Social Security survivors benefits over here, and there are, of course, we walk through the impact, etc., and retirement, risk associated with the retirement, decreased income, so on and so forth. This is where it's not really insurance, but it is. It's not called that. Pension plans, 401ks, 403bs, IRAs, insurance against property loss, flood insurance, homeowners insurance, automobile insurance, etc., and liability, has to do, again, with negligence. Homeowners insurance oftentimes covers these things, malpractice insurance for doctors, etc. You get the idea. So once again, in the planning stages and planning your insurance program, is you want to set up what your goals are, what your intentions are. If you're looking at life insurance, or, well, in this case, we're talking again about automobile insurance or homeowners insurance. What is it that you want to insure against? How much is enough? How much auto insurance do you actually need? How much protection do you need? Similar with the homeowners insurance, you want to insure the replacement value, for example, of the automobile or the a new car. Your car is 3 years old, and you want to get to replace that vehicle. And at any rate, those are the goals you set, and develop a plan to reach those goals. How much is that going to cost you? How much does it make sense? Is the opportunity cost too high? Would you prefer to cut back some on the insurance, and so on and so forth? And then once you develop those plans, you go ahead and put that plan into action, and you see how things work out for you. Meaning, you find out that you're paying too much for your insurance, or you're over covered, you have too much auto insurance, or you have too much insurance on your home, it shouldn't be as much, so you go back and reduce the coverage, or vice versa, you want to increase the coverage. All these things are things that you kind of figure out, sort out as you go. So planning an insurance program, setting insurance goals, again, to reduce the possible loss of income due to premature death, illness, accident, or unemployment, property insurance caused by perils, income, ensuring income, savings, and property due to personal negligence. These are all things that you're looking at with insurance as you're going forward. Develop that plan. What is the plan? What do you need to do? What do you need to insure? Well, how much do you want to insure it for? What kind of insurance should you buy? Do you want to buy term insurance, whole life insurance? Lots of different options that are out there for you. And you put that plan to action, and you check your results. Insurance needs and goals change. Do you reach the point where you don't need as much insurance? You would want to depend more upon your retirement savings, and you don't need that insurance, or you want to increase your insurance, and so on and so forth. Anyhow, so back to onward with property and liability insurance. Recent major losses, again, this goes back a few years, been some subsequent to that, but the Superstorm Sandy in 2012 resulted in $18 billion in damages. Katrina, Rita, and Wilma, going back to 2005, $50 billion. And property values go up. The damage that's associated with such things tends to increase proportionally, if you will. The value of the property goes up, property is destroyed, the losses that associate with that go up. Potential property losses: home, automobile, furniture, clothing, personal belongings, and when we do experience these catastrophes, property and liability insurance. Liability is equal to equates with the legal responsibility for the financial cost of another person's loss or injury. Who's liable for this, right? Liability due to not ignorance, but to negligence, failure to take ordinary or reasonable care. Vicarious liability: you are held responsible for the actions of another person, such as your child, vicarious, living through someone, such as your child throwing a ball through a neighbor's window. So you're responsible for your dependents, for your children, their actions. If they cause harm to someone, you would be responsible, you'd be held liable for that financially, etc. Home and property insurance. Homeowners insurance coverages damage or destruction of the building in which you live and other structures on the property, including such things as a garage if it's separate from the home, for example, sheds, trees, shrubbery outside, Additional living expenses may be limited to 10 to 20% of property value, may be limited to 6 to 9 months. So again, what that means is that if the house is destroyed, that's where that additional living expenses will come in. Personal property, furniture, appliances, clothing, and this is where you want to be sure that you go in and take pictures if you have something that's worth value, and make note of it somehow, some way to record it. Taking pictures, having them on your phone, or having them in some safe place. Personal liability and related coverage, insurance to injuries to others on your property, specialized coverage, earthquake endorsement, flood coverage. Those are tough to get if you're in areas that are prone to earthquakes or floods. It's very difficult to get. Oftentimes the government has to step in to help in terms of subsidizing your flood insurance, for example, if you're in an area that's prone to hurricanes and flooding, etc. At any rate, onward. So the household inventory, when you inventory the contents, go through your home, and again, you're going to be taking stock of what it is that you have in your home, not just grandma's chair that's 150 years old, but all the other things that you have in your possession, so that you know that if something happens, then something as simple as a lawnmower that cost $500, it's stolen, or if it's destroyed, someone drives over it, or something that's on your property and they run it over. Just anything and everything. You want to try to keep track of everything that you have in your house, do an inventory of the contents, so that just in general, so you know what they are, and you know roughly what the values of what these items are to replace in particular. Personal liability and related coverage. Personal liability, there's what's called an umbrella policy, which is also always advisable. Also called the personal catastrophe policy, supplements basic personal liability coverage, $1 million or more in coverage. So it's additional coverage. It's kind of it's called an umbrella coverage or policy because it kind of covers everything. Medical payment coverage for minor injuries caused by you, your family members, or pets occurring on your property or away from home. Again, just some additional coverages that would come under that umbrella, if you will, of homeowners insurance. Specialized coverages, endorsements, added coverage for earthquakes, flood damage. Personal property floater covers specific items of high value, jewelry, furs, art collections. And these are things that if there are some high value items, you identify them up front so that they can be covered specifically. Renter's insurance, moving on. Broad form covers personal property loss or damage specified in the policy. Comprehensive form protects property against all perils, all things that could go wrong, so to speak. Renter's insurance is relatively inexpensive. I'd mentioned that before. Replacement value coverage cost is more costly. Covers property only in your home, usually includes liability coverage. Many renters do not have insurance, and this is a mistake, frankly. The cost is relatively low, and it's something that you should certainly have if you're renting, because things can happen in your apartment just as easily as they can in a home. Homeowners policy forms, basic form H01 protects against such perils as fire, lightning, in other words, against natural catastrophes, natural causes. Windstorm, hail, smoke, theft, and riots. The broad form homeowners 2, wider coverage includes falling objects and damage from ice, snow, or sleet, falling objects including trees falling on your property, and so on and so forth. The special form H3, this is where you have those endorsements, where you're specifically all other risks, unless they're specifically noted, with earthquakes and floods or even nuclear accidents. It's interesting, but that's true. Tenants form, this is the homeowner's insurance policy for, of course, for The coverage personal property against listed risks. Comprehensive form expands that HO3 coverage to replacement costs. So you're replacing something. You may have a vehicle that's 5 years old, and in order to replace it, it may cost more than what the vehicle is actually worth. And that's where the replacement cost comes into play. Condominium owner covers personal property and building additions. In addition, policies usually cover items such as credit card fraud, check forgery, temporary repairs, fire damage charges in areas with such fees. So there's a vast coverage that's included. Things that aren't also, but there are a lot of things that are covered. And you can pretty much cover anything that you really want to if you drill down on these with the different options. But determine the amount of coverage needed. You want the replacement value for your home, The value, so you might have a 30-year-old home that cost, $100,000 30 years ago, but the replacement cost for that home, the same size home, et cetera, might cost $300,000 today. So it's making you whole. It's replacing the home, if you will. The value of your home's contents, and again, those specific items, the high value items that you want to identify for your insurance purposes, jewelry, furs, etc., and also liability coverage that we talked about before, which is covered under that umbrella policy that we had mentioned. Policy provisions look for policies with full coverage. Co-insurance clauses requires that you pay a part of a loss. Claim settlement methods, actual cash value, replacement cost, less depreciation. So you've got to be careful of that. Replacement cost itself is full cost to repair or replace a damaged or lost item. Some companies limit to 400% of actual cash value. So there are limitations on this, 10 to 20% greater than actual cash value. That might be whatever the limits are. That's what you're trying to shoot for, is it you don't just want the reduced value of something because of depreciation over a period of time. You want to replace whatever that item is. So you would to replace your 5-year-old car, you would be getting a new car, and that fits the bill of that 5-year-old car in essence. At any rate, factors that affect home insurance costs: location of home, of course, location, the type of structure, if it's located on the beach, etc., type of structure, if it's a wooden home versus a brick home, coverage amount and policy type, homeowners insurance discounts if you have additions such as for safety requirements in terms of alarm systems, smoke detectors, or if you bundle your insurance, if you have insurance on your car with the same company. Very common, so you get discounts for those types of things. Company differences, again, you want to go through and compare the cost. And there are numerous companies out there which you can purchase that insurance from, whom you can purchase insurance from. So automobile insurance coverage, the financial responsibility law, their state legislation requires proof of financial ability to cover the cost of damage or injury caused in any automobile accidents. All states have compulsory automobile insurance laws. Does that mean that everyone has insurance? No, obviously not. At any rate, two major categories of auto insurance: bodily injury coverage. And that has to do with the people in the vehicle. Bodily injury liability, medical payments associated with it, and uninsured motorist protection. If someone gets in an accident with you and it's that other person's fault and they're not insured, your insurance has to step in to make you whole, to take care of it. Property damage coverage. This is actually speaking to the vehicle and other property. If there's property damage liability, there's also collision portion of it. That's for your vehicle, the other vehicle, if you are at fault or whatever percentage at fault you are. Comprehensive physical damage. Again, these are all, on the one side has to do with the people cost, the other side has to do with vehicle and other damage that's done in such an accident. So bodily injury liability covers financial loss due to legal expenses, medical expenses, lost wages, etc., associated with injury caused by an accident for which you were responsible. Expressed as three numbers: 100, 350. So what that means is that again, maximum coverage is in thousands. So 100,000 maximum paid for injuries to any one person, 300,000 maximum paid in total, 2+ people, 50,000 maximum paid for property damage. Okay, so that's basic coverage, bodily and liability insurance, if you will. Automobile liability insurance again walks through that 100, 350. 100,000 limit that will be paid to one person in an accident, 300,000 limit to all that are all persons involved in an accident, bodily injury, and then the other side, the property damage, that's the $50,000. That's liability coverage insurance on a vehicle. Motor vehicle body injury coverage, medical payment coverage, covers the cost of health care for persons injured in your automobile, including yourself. Also covers you or your family members injured while riding or hit by another vehicle. So again, the insurance goes with you, if you will, and or your family, rather, as well as your family. Motor vehicle bodily injury coverage, uninsured motorist protection, protection against the risk of getting into an accident with someone with no insurance, the uninsured motorist. Underinsured motorist coverage pays cost if your car is hit by a person who doesn't have enough insurance to cover the damage they did to you and or your car. Motor vehicle property damage coverage. Property damage liability covers damage to another person's vehicle or the other person's car, rather, when you are at fault. Includes damage such things as street signs, buildings, etc. And again, this is there are numerous examples of this. Collision coverage pays for damage to your automobile regardless of who is at fault. If you are not at fault, your insurer will try to collect from the other driver's property damage liability first. Coverage is limited to the retail value of your vehicle. That's collision. Comprehensive physical damage coverage, damage to your vehicle not caused by a collision, such as fire, theft, vandalism, glass breakage, hail, sand, or windstorm, falling objects, or hitting an animal. It happens. Everything happens out there, as we've seen from some of these commercials. No fault insurance. Each driver collects from his or her own insurance company for medical expenses, lost wages, and related injury costs. Coverage varies by state. It's intended to provide a fast, smooth method of paying for damages without determining fault. Problems may arise due to variations among states, depending upon what state you're in, right? Other coverages: wage loss insurance, emergency road service coverage, rental reimbursement coverage, automobile insurance costs, legal concerns. Have enough coverage if you are sued. Recommendations are, again, that 100,000 for the individual, 300,000 for all that are involved with bodily injury liability. Plus, for additional, you can get an additional $1 million coverage. That's the umbrella liability policy. And lastly was the property value. Between 50 and 100,000 suggested for property damage liability, because that can be eaten up very quickly. You get into an accident where 2 or 3 cars are involved. If they're totaled, etc., it can really pile on very, very quickly, hitting that $50,000 mark and that $100,000 mark for that matter. Motor vehicle insurance premium factors: the vehicle type, make, model, theft rate, all the things that go along with that, rating territory, accidents, auto theft, and vandalism rates in the area in which you live, which your primary residence is. Driver classification, age, sex, marital status, credit history, driving record, driving habits, assigned risk pool for those unable to obtain insurance. Again, assigned risk pool for those who are unable to obtain insurance, meaning you're paying at significantly higher rates. Reducing automobile insurance premiums, compare companies. Premium discounts, establish, maintain good driving records, be a non-smoker, install security devices, car alarms, etc. Insure with the same company, multiple vehicles, and homeowners insurance, etc. And last situation would be larger deductibles. This, of course, larger deductibles would be for, especially if you have an older vehicle, that just say, for example, your vehicle is the blue book value rather is the resale value is $2,000, and your deductible is at $150. To replace the vehicle, you would be getting $2,000, whereas if you had the same insurance on a vehicle that was worth $30,000, the point is that you're playing the numbers games all the time, especially if your vehicle is older. You may want to go with larger deductibles, is really what it boils down to. And this is all based on your own preferences and your own experiences and your own guesswork. So again, your learning objectives, back to the learning objectives, to walk through those. I'll just wander through these. We just have a couple of slides here. Homeowners policies provide coverage, again, for buildings and etc. and lots of weird things that you would never expect, but many things are covered under homeowners insurance policies. The factors that affect that homeowners insurance coverage. Moving on to insurance, auto insurance, where we're looking at bodily damage to persons and property damage to vehicles and other property that might be involved. And motor vehicle insurance cost, again, depends on a variety of things. Again, could be a major portion of your budget depending upon what state you live in. Michigan has extremely high insurance rates, the highest in the country, I believe.